Hi everyone, it's Jesse with DealWorthIt. Thank you so much for joining us on today's webinar. Today we're going to go over the new real estate underwriting software called DealWorthIt. We've been spending quite a few months updating this tool. It was actually released last year. We are now on version 3, so we've got a lot of user input. We've been doing this for quite some time now. We've made a lot of modifications to this tool to make it very, very easy for those of you who are investing in multifamily real estate. So at the current moment, this is only for multifamily real estate deal, mixed use deals. So anything to do with multifamily. You can run other types of commercial properties on it, like storage units, but this is mainly set up for apartment buildings. Now, that does not mean that we won't be adding new features and new market sectors in the future, but for now we have set this up for multifamily investors and multifamily syndicators. I do see a couple questions already here in the comment. As far as the types of multifamily deals you can analyze, you can go from 1 to 4 units, which is more considered that single family, or large commercial buildings. It doesn't have to be 2, 3, 4, 500 unit deals. It could be smaller deals, mid-sized deals, very large deals, whole portfolios. The tool is really set up to make it easy to analyze all types of multifamily assets. So if you could please hold off on the questions until we reach the next section. At first, I'm just going to show you all the dashboard, and then we can go into the quick underwriting and finally the detailed underwriting. So just please hold off on the questions until we finish a section so that we can go over it and we're not jumping back and forth too much. So just to get started here, this is your DealWorthIt homepage. This is the dashboard here. What you'll find up here is your account. So you can go up here. Here would be your profile, your subscription status. We do have 3 subscription levels. So we have a silver edition, which is the quick underwriting tool only. So if you're just looking for a quick version to analyze deals within a couple minutes and be able to move on to the next one, that is the silver edition. The gold edition gives you the detailed underwriting. Now this is for if you do have deals that are ready to go and you need an actual underwriting model. This is perfect for that. This replaces all of those spreadsheets, so you don't have to accidentally delete one cell and then the spreadsheet no longer works. This tool makes it very simple and easy to run multiple scenarios, and we'll go through that. And then there is the Diamond Edition, which is a team version. So if you have an acquisition team, 3, 4, 5 people, you can add them directly into your DealWorthIt account. And that subscription level is the Diamond Edition. Here's your account settings. You'd go through to manage your team. We do have the activity notification here, the app notification. So here we actually just released a video on the quick underwriting. You'll be able to check all of that within these app notifications. There's the quick tour feature here that'll go through each section of this for you. Up here you can search for deals by name, and then this button is actually very important. Without user feedback, we can never really upgrade these tools. So it really does rely on the community. Obviously we're actively using these tools. We're underwriting deals on a consistent basis, but we do need your input. So if you find something that's not quite right, if there's a bug or something that's not adding up for you, if you can't figure out what something's doing, please submit something up here into something's not quite right. If you have a suggestion for us, if you want to suggest a new feature or whatever that is, please put that in a suggestion, submit that feedback. We do review every single one of those, and we take action to upgrade the tool. We're on version 3 based on user feedback. So if you're interested in using the tool and you can provide us with some feedback, that would be great. It's only going to improve the experience for you and everyone else that uses the tool. We also love compliments. So if you're interested in giving us a compliment, you really like the tool, that feedback is great for us. That helps us continue to keep going and keep growing this tool and growing our community as we move on into the next years of this massive opportunity in the multifamily space. I think everyone needs some way to analyze deals on a quick basis, and that's what we've provided here. Right here within the dashboard, you can analyze a new deal. You notice I have the quick underwriting and the detailed underwriting. So this is the silver, this would be the gold edition or the diamond edition. With diamond and gold, you do get both. Here's the deals that we've analyzed recently. Here's our actual recent deals, and then these are the states that we've analyzed deals in. So as you can see, I analyzed a couple deals here in Wisconsin. This is all within the dashboard for you. Now we can go into the deals section. So these are all our deals. Here's the market deals. These are deals that we're currently analyzing. These are deals that we've now reached the second step where we're more towards the LOI space. Here's deals that are portfolio deals, and then deals that we've missed out on. But we continue to track these deals and see what they traded for so that we can see how good our analysis was. This is where you would store your favorite deals. Here's where you would manage your team. With the Diamond Edition, you can add up to 5 people to your account. And we have this help section. So there's the quick, detailed underwriting scenarios. All of this is actually on the help page. So we have a support page for you. I'm not going to jump into that right now. And again, missing a feature requested here. That's a big part of this. Like I said, this is community based, so we need everyone's input to continue to grow the tool. You can also chat with us right here. Our chatbot's ready, as well as our staff here ready to take on your questions whenever you do have a question on properties. So let's just jump into a deal right now. I'm going to start with the quick underwriting. So before I proceed, does anyone have any questions on the dashboard or anything within within this first section before we move on? So one of the questions is, what's the key differentiator between DealWorthIt and other underwriting tools? Well, DealWorthIt lets you quickly and easily analyze deals within a matter of seconds. We also use a little bit of AI to help analyze these deals. We pull a lot of data in for you on these properties, so you don't have to do a bunch of research outside of the tool. We make it very, very simple to underwrite deals. And as I'll show you here, it's going to take a little bit longer than it normally would take me because I'm going to be explaining things. But you can see how quickly and easily you can analyze a multifamily deal. And it's a very, very simple process. So let me just jump into that. Thank you for the question, Amanda. I appreciate that. Anyone else, again, as we finish this quick section, I will take on those questions after the quick, and then we can jump into the next one. So we're going to go right here, right now, and we're going to enter in 30 Market Point Drive in Greenville. So as you can see, it's already pulled up the property. Here's the source of the property. It's going to actually pull you to apartments.com. It's going to take you to the actual deal. There's 94 photos of the property, so you can actually pull this data. You can take your time, look through this, check out what's going on with this property. It's all right here within the tool. I'm going to analyze this deal based on the average rent from the broker. So the average rent was $1,310. Their other income number was around $28,000 per year. There's no commercial building in here. There's no other commercial space in here, so we're going to leave that section blank. We're going to hit the next section. So we allow you to analyze these deals using a few different scenarios. So if you have the cap rate and operating expenses, whether you have the purchase price and operating expenses, or if you have the purchase price and cap rate. So I have the purchase price and I have the operating expenses, so I'm just going to go off of that because I have those numbers. This is their purchase price. Their expense ratio is around 47%. So I'm going to do a 47% expense ratio, and I'm going to click Analyze Deal. So what DealWorthIt is doing now is it's pulling your data into this full underwriting. So as you can see, we have the quick version, and on the left side, here's your inputs, and on the right side, here's the outputs. So we can see our gross income, just based on what we entered in earlier, is around $4 million. We have our expense ratio of 47%, our NOI of $2.1 million. It's going to require about $11 million of equity based on the current debt inputs, and the debt cost is $1.9 million. Now we can see our free cash flow, very, very low on this property to start. Our debt service coverage ratio is 1.1. That is not very good. It's a 5.3 cap. In today's interest rate environment, you need to be buying properties over the interest rate. So that's likely not going to work, but we're going to throw in some more numbers here. We're going to take about 3% for concessions and delinquency. Again, we know that it's occupied to 97%, but we're going to underwrite it at 95%. This property was literally just renovated, so it does not need anything. It's a new property. We're going to still put in, I'm going to throw in like $500 per unit here, just as a little buffer, right? We like to have a little bit of reserve for some CapEx if there are things needed. Again, it is a new property, so there's not much, But say we want to go in and change something to like a low flow faucets or LED lighting fixtures, whatever that is. We want to have a little bit of buffer there for the property. So I'm going to throw in a little bit of CapEx money, even though we know it really does not need that as it was built in 2016. There's no commercial rent, so I'm not going to change anything up here. We're going to go into the acquisition now. 25% down payment is not something we're going to see, especially in this environment. We're going to be in that 35% range. As you can see, it's bumped up our debt service coverage ratio. We're getting closer, but we're going to go down here, and I'm going to base this purchase off the 10-year Treasury. So the 10-year Treasury rate right now is 4.98. We're going to add our lender spread of about 1.5 on top of that. So just for easy math here, I'm going to say our rate is 6.5%. On a Class A asset, the spread's probably going to be in that 1.5 range. Now, we may be able to buy that down a little bit, but I'm just going to leave it in the 6.5 range. Since we got agency, this is likely going to be at least 36 months of interest only. Now, notice what happened up here. The DSCR has jumped up to 1.2. These are as is. So this is on acquisition year one. This is what you're looking at. So if we do have this interest only period, this is evaluating your first year here. So notice the payment is $140,000 a month when we're on interest only. When we're on principal and interest, we're at $170,000. I'm going to add some closing reserves in here. Now this is going to be the money that the lender is going to require you to have in an escrow account when you close these deals. I'm going to throw $500,000 in here. That may be a little light for a deal this size, but I'm still going to throw it in there. Here's the amortization schedule now for your loan. So you can see we break it down year by year. You can see you're only paying interest year 1 through 3, and then in year 4 you start to pay that principal down. So there we go on the acquisition. We're going to move on now to the next section, which is the future tab. We're going to project 1-year intervals. Appreciation rate 3%, income inflation 3%, expense inflation 3%, vacancy 5%. I'm going to leave that as is. We would want to refi this property in the fourth year, just because we are out of that interest only period. We're going to say this is a 5.1 cap rate now. I'm going to just leave this at a 5 cap. Just assume that we're going to get a 5 cap on this property valuation 4 years down the line. It might be a little less when interest rates come down. I'm actually going to refi this at 5%. I'm going to leave that because I do believe that the rates will be down, especially within 4 years. And we'll throw another interest-only period on this, say another 36 months. And it's going to cost you probably around 3% to refinance this loan. So we're going to throw 3% here, and that'll be your refi cost. And now what happens is, since we've added a refi, we can go in and look at the metrics for that. So our NOI at the time of refi is 2.2. It's appraised at $45 million. Our new loan is 31. Take out our cost, repay the outstanding loan, and see we haven't paid any of the principal down because it was interest only. Our capital account balance, what we needed to close, was $15.8 million. We've returned $4.5 million. Now we only have $11 million into this deal. We're going to go to the sale assumptions now. I would want to sell this likely year 7 once that interest only period again expires. I'm going to keep the rate cap exactly the same, the exit cap rate, because I believe, at that 5 rate, again, 7 years down the line, we're going to say we used about 50% of those reserves throughout the time of the property. Say we were short a month on rent, or we had some bad debt that month, or something came up, we used our reserves. So again, we're going to expand this section. Our NOI by year 7, based on our income inflation numbers, should be about $2.4 million. Here's our remaining reserves from the 500. We got 250 left. Our sale price, sell cost, outstanding loan balance, we have $17 million there. Return of the member capital and our net proceeds is only $4.7 million. I already know this deal is not going to work because it's not meeting a debt service coverage ratio, and this cash on cash is very low. Now, that fair market value, they're asking $39,99999 repeated, whatever. That is not going to be a real number to sell at, and we'll show you how to run multiple scenarios after this. But just to show you, here's your P&L. So here's your income and expenses. We're going to go through. We have your gross income, your concessions, vacancy, rental income, commercial rent, operating expenses, your income analysis here. So we break it down, you hit the I, and you can see what the capital account balance was there, what that number is comprised of. We can see our cap rate throughout the property. Our cash on cash return is extremely low on this deal. Honestly, wouldn't buy this deal at this price, but we're going to go, we're running it through the numbers. So one of the cool features here on the loan analysis is we can see what our potential cash out refi is. Probably wouldn't even refi year 4 because there's not a lot of cash to take out. Unless we were in desperate need for that loan and the rate was, if we weren't able to service that debt for some reason, I wouldn't necessarily have refinanced that year unless we're just continuously going to refinance every, 3-4 years when the interest-only period expires. And depending on prepayment penalties and things like that, that might be a strategy. In the quick version, there is no place for you to insert prepayment penalties and do that full analysis. That is in the full underwriting. This version is just to let you know if you want to look at the deal or not. Here you can add deal notes. You can set up a new folder. You don't have to set up a folder, but you can set up, throw the offering memorandum in. You can put the P&L, the rent roll, all of the information, your due diligence docs. You can keep it right here within the tool. Everyone on your team can then access that pending that you have a team account. And then we have our research section. So in the research, you can see our market trends. It looks like the annual change in this market is low. The rents are decreasing. Probably not something we can force that much appreciation in unless we are below market rents. I know this deal specifically, the average rent in the area was about $14.75. So we can bump rents on this deal. But it does show you areas around us, the average rent for studios, 1 bedrooms, 2 bedrooms. Here is the actual property comps in the area. So we can see, let's look at, just pull one of these up. It tells you exactly what they provide. So here is all the amenities for that deal, for this asset. This looks like a newer asset as well. We can pop into here and see, the pictures available. It looks like that, this is a pretty new asset. There's a lot of similar amenities. Now we can see here they charge some extra fees. So this is some extra other income items that we may be able to charge for. 276 units, pretty close to what we have. We have 246 on this one. And you can go through each one of these and look at that information. We also have this feature built in. We see that this property, well, that's a great sign already. Whole Foods is right here. That's pretty fantastic. That's something you want close to you. Yeah, within a half a mile. Whole Foods does not put a Whole Foods in unless they've spent millions of dollars on research to make sure that this market is good enough to support their grocery store. So really good to see, Whole Foods very close to you, Trader Joe's. You can go through, look at pharmacies, universities, what schools are around, where's the shopping mall, malls within a half a mile. We can look at that mall, see what kind of shops are in that. Plenty of restaurants. I imagine a lot of these are actually at that mall. Hospitals. We have our walk score right here. We can see it's not really a walker's paradise. It's pretty low, 39 walk score. I'm going to go over to the demographics now. Now we can see, here's the population. It does pull the data. You can see when the data was pulled. That was a couple of years ago. So if there is available census data that comes out, the tool will update that. Based on the current income here, it looks like we are at about household income of $68,000. The rent on this property is only $13.10. So anyone who's familiar with how this investment class goes in multifamily investing, if your average rent is $13.10 and you multiply that by 12, we're at about $15,000 a year for rent. If you divide that by the average income here of the $64,000, the rent to income ratio on this property is around 23%. That's very low. We can probably go up to about 30%. So we know there is some wiggle room here just based on that simple math. I don't like this deal at this price, at this $39 million price. I think it's a little high, but I want to keep this scenario because this is our baseline. So now what we're going to do is we're going to create a new scenario, and we're going to name this. I'm just going to call it offer one. Oop. We're going to create that new scenario. Sorry, that's my fault. My mouse is a little sensitive here. And the only thing I'm going to change on the scenario now is I'm going to edit this purchase price. I think we need to be in around the $36 million range. So I'm going to throw $36 million into here and see what that does. Right away, obviously, it jumps our debt service coverage ratio up. That's a great sign for us. A little bit more free cash flow, better cash on cash returns. So this is just based on their current projections. We'd be at that 36 million. I'm going to do another scenario now. I'm going to clone this based on our current scenario, and I'm going to call this pro forma 1. I'm going to create pro forma 1 scenario. Now, like I mentioned earlier, the average rent in the areas is that $14.75 on this property. Now, let's see what that does at our $36 million asking price. That gets us into a really, really healthy cash-on-cash return scenario. If we go into our future, if we go into our future tab, we can now see that this scenario, it probably obviously it's a much better scenario, as we know, because we've raised the rent and we've reduced the purchase price. So I'm going to go in here, look at the numbers, see what our proceeds are. Definitely a much better return on this property once we've lowered that price and increased the rent. So our pro forma, we can see that this is going to return a decent amount of money. We're going to almost get all of our capital back on the refi, pending we get it in this 36 range. Now this is still doing the same. It's still doing the same inflation rate, appreciation rate for this asset. And on sale, we can see that we're going to take in another $14 million. So this is a really good deal at this purchase price. But again, it's hard to, it's probably going to be hard for them to adjust their price down $4 million. But if we want to, be in reality, right, the deal's not going to sell for $40 million. So I'm going to go up here and I'm going to filter these scenarios. So we see this is the main scenario as is. Here's the offer price with the as is metrics. And then here's our pro forma with that new rent bump. So we can go through and we can just keep comparing these scenarios. What I like to do is go in and actually see, what we're looking like comparatively. We're up, our DSCR is well within range for the bank to give us a loan. And at the $36 million mark, the bank is going to give us that. Their DSCR requirements are about 1.35 now. So another thing we might be able to do on this as well is buy down that interest rate just a little bit, which would bump up our closing reserve amount there. So we're at a pretty good situation here with offer 1 and pro forma. So what I'm going to do now is I'm going to start taking some questions here. I think it's important, anyone who's had questions, let me just scroll through here. Thank you, Daniel, for handling some of these just within the chat. For those of you that do have more questions on this, yes, there is. Somebody's asking about, Mike, I know you're asking about the custom reports. You're not going to see those right now in this specific deal because right now we're not in that detailed underwriting. We are still able to share this, but you're not going to get the same sort of report you would in the detailed, and I'll show you that in the detailed underwriting. Thanks for the question, but I will get to that. What kind of support and assistance do we offer? So right here again, we discussed this earlier. If you weren't on the call, Betty, this right here is the chat bot. You can talk to us. Someone on our team will get back to you. Another thing you can do up here, again, is the provide feedback button. So if you do have a question or concern, you can use the provide feedback button, or you can send us a message here. You can also email us, jesse@dealworthit.com or daniel@dealworthit.com. So for support, that is very, very important. It's important to us to be able to support you through all of this. And I really want to take the time, to answer those questions so that you're comfortable using the tool and it becomes part of your daily underwriting routine. I don't know about you all, but my inbox has anywhere from 50 to 60 new properties in it every single day. And it's impossible to analyze those in a spreadsheet model. Using a tool like this, as you can see, maybe 10 minutes, and that's me talking, through the actual features on here. Within 10 minutes, we've ran 3 different scenarios on a property, and now we can actually jump into the full underwriting. Greg, I do see you can compare side by side. I know you asked that question, but I hadn't got to that point yet. You can compare the deals side by side. And who put that? Martin. You can incorporate your own assumptions. You don't have to. So that's what we're doing here on the pro forma, right? These are not the assumptions from the broker. These are our assumptions based on our analysis of this property. We know that we can raise the rent up to market rent to $14.75. So those would be our projections. That's not something that's coming from the broker. Now we're going to move into, since we do like this deal, I'm going to take offer one because this would be the scenario that that I would be using. And I'm going to convert this. I'm going to convert this over to the detailed underwriting. So now that we're in the detailed underwriting, it's going to allow us to do a lot more analysis on this property. As you can see, the name of the property shows up, the number of units, the purchase price. I'm going to run my underwriting on offer one because I know main scenario doesn't work. So instead of wasting my time on their price, I'm going to run it at the price I need to buy this property at. So in this overview section, we're going to use that $36 million purchase price. I'm going to go into the operating metrics. I'm going to make the delinquency rate here about 1.5%. So in the quick underwriting, these are combined. Here you can actually separate that out. I'm going to drop our concessions to 2%. So now I'm getting a little bit more conservative. Before combined, we were at 3. Now I'm about 3.5. Just, again, to be more conservative. Right here in the income section, here's the average rent that we had. One of the things that you can do in the detailed that you cannot do in the quick underwriting is you can actually import some data from a spreadsheet. So we have a DealWorthIt template. If you don't have a T12, if you don't have financial statements or rent roll from the broker, nobody gave you that information, say they sent you some information in an email, we've actually put this together for you. So you can put in the rent roll, the unit mix, what the current rent is, how many units there are, what the other income is, the operating expenses. If you don't have some sort of spreadsheet or way to enter this and you don't feel like clicking within to add each line item manually within DealWorthIt, you can actually go through here, enter some information into a spreadsheet, and then the spreadsheet itself, when you upload it, will automatically map those fields for you. The other thing that we can do is we can upload a rent roll or a T12 directly. So if I wanted to, right, and we want to do it that way, what I'm going to do is I'm going to delete the income information because we're going to upload the T12, and I'm going to delete the other income information because, again, we're going to upload a T12 for this information. So we are actually just going to go through and remove this because it's full underwriting now. I want to be able to import a spreadsheet. I have a T12 directly on this property, so I can take the T12. Once I find it in my documents here, there we go. Here's the T12, and I'm uploading that. And as you can see, it imports this data. So this is for 246 units. This column, I'm not going to map. This is just, a title column. Here's a title column again. Here is the income per month. Now we can do it on a monthly basis and map each one of the amounts in the month, or we can do it on an annual basis and only take this amount. I'm just going to do the monthly just to show you guys. So we're going to take the rental income here. We're going to just say that's rental income. The other income. Now we can go through like this and individually click each one of these items and then map them as other income. I don't really need to do this for this example, but I did want to show it to you. So, oh my gosh, they got a lot of other income here. Each one of these line items is now in our bulk actions. We're going to mark that as other income. So I'm going to apply that. Now all of those are under other income. I could have just taken the totals there. So here's the total revenue. I'm not going to do that. Property expenses. What I'm going to do, just to make this simple, is I'm going to map total payroll. That's an operating expense. Total marketing expense, operating expense. Instead of clicking on each one of these, but that's really just for y'all's example purposes here. I don't want to jump through and take, a few extra minutes. I just want to get you through this so you can see exactly what that looks like. Our operating expenses, I could have taken the totals on the bottom as well, but I did want to have that breakdown of what those expenses are, because we can see where we're able to save a little bit of money and where we're maybe able to cut some of these expenses. So total, I could have taken the totals line, but I wanted to go through and have that, at least that breakdown. So now what we see here is the rental income is 58% of the data. Rental income, our other income, another 11% of the data is our other income, and our expenses broken down in each category. And all of that is broken down directly in here. And then we're just going to click import data. And what happens is now this data is getting mapped directly into the software. All right, so now that we've imported this data, as you can see, it's telling you need to update the loan information because we've updated the actual income on this property. I'm actually going to take this pro forma. I'm going to delete this because it has just this scenario from the quick underwriting. So I'm going to delete that pro forma at this time because we're going to clone the scenario once we're fully done underwriting offer one. Now we're going to jump into the expenses. As you can see, it took the expenses that we've imported. The capital expenses are still here, that CapEx. Again, only $500 per unit. I could probably bump that up if we wanted to. Maybe we'll have another, $1,000 in there. We can finance it possibly on a per unit basis or on a fixed basis. You know what? We're going to say it's not financed. We need to do, I don't know, a roof on a couple of the buildings. Let's throw in $150,000 in there just for another CapEx general improvement. We can go over here to reserves. Notice again here at the bottom, since we've changed the price of the property, we need to update that loan. So we give you that warning throughout so you know you need to update that loan. So here we're going to go into the capital reserves. And if you noticed here, each one of these have a little dot next to them, a little I, that you can check what exactly this is for. So we're going to manually add our capital reserve. So if you notice down here, HUD loans, Freddie Mac, Fannie loans, if you don't know what type of loan you're going to get, these are pretty good estimations for you of what you need per unit per year. So we're going to go what the frequency per year. We're going to go per unit. We know that it's 246 units. Oh no, my computer was dying. Oh, there we go. We know it's 246 units. And I'm going to be conservative. Even though this building's pretty new, I'm still going to go that 300. That's a good capital reserve for us to put in there, the replacement reserves. And one of the questions was about reserves earlier. So glad we're on that topic because I can actually show you here. When we're on reserves, you can say you're going to estimate how much you're going to use. So we can estimate that we're going to use, maybe we use 40% of this money annually. Now this is to make unit repairs and updates that aren't CapEx activities, just standard wear and tear is capital reserve. Let's say we're going to use 40% of that per year. Now it's a little bit harder to calculate that generally in the spreadsheet models. They don't usually have something for you to do with those reserves. Another thing here on the closing reserves, again, this is the financial side of it. This may be like a year of interest reserves. This could be an escrow for taxes, insurance. These could be, all of those things. I'm actually going to bump this up just because of the size of the deal. I'm going to make this around $750,000 of closing reserves. And that's just a really nice buffer for us to have for this property. So as you can see, things are continuously changing here. Again, this is the in-place deal summary. We're going to now go over to the acquisition. Here's that loan we had earlier. Again, we need to change this. I'm just going to make it easy. I'm going to delete this loan. We'll delete it, and now we can add a new loan to it. So I want to add something. It's a new loan. We can either put an assumable loan, a seller finance loan. We'll just go with new loan. We're going to go with fixed rate instead of adjustable. And I'm going to add a prepayment penalty because all of these do usually have a step down period for a prepayment penalty. Let's just say it's a 5-year prepayment penalty. So we'll go 5, 4, 3, 2, 1. Nope, not 10. 1. So if we were to get this loan and want to refinance year 3, we're going to pay a 3% prepayment penalty on the original loan amount because of how this loan is structured. So we'll go again in here. We'll go, it's actually going to be like, let's just say it's 648 instead of 6.5. 30-year amortization. We'll still do 36 months interest only. I'm going to put 35% down. That's just a safe number. As far as like staying conservative, I like to have a nice bit of equity built into there. It definitely makes the property cash flow better. And for us to raise a couple extra $1 million to be in a much more secure position, certainly worth it in the long term. Again, we'll go into the deal summary. See, there's about 4% cash on cash return. We'll go into this closing cost section. I'm not going to adjust this, but you can add other closing costs. You can break it down line item by line item. For this purpose, I'm just going to go through and leave that as is. And here's the part that isn't really available in the quick underwriting version. The quick underwriting version does not allow you to add in any sort of fee structure if you were to be doing acquisitions. So for us as real estate syndicators in the multifamily space, we have fees that go along with this asset. So we're going to go with a 2% acquisition fee. That's pretty standard, and we'll do a 2% asset management fee. So we see our acquisition fee year 1 is going to be $720,000, and our asset management fee is almost $78,000 a year based on its current rent. So you are getting paid fees as a syndicator, and we do allow you to now put that in here. So whether you want to charge fees or not, there's a way for you to add those in. We can now go into our future tab, and here's where we can have a little fun with the numbers as far as like forcing the appreciation goes. We could do this in our pro forma, or if we already know that we're going to do some value add. Let's say in this example, the studios, we can raise the rent $50 a month. Say there's 60 studios, and we can start that like 3 months into this. We're going to go ahead and add that value add in here. Now, maybe we have to wait a little bit long for the 1 bedroom. Let's say those are about $100 light per unit. We know they're a little bit lighter than that. I think the rent delta on this property on average was about $150 to $175. I'm still going to do it conservatively. I'm going to say there's 121 bedrooms. And we're going to say that starts in month 13. So it's going to take us about a year to raise that rent across all of those units. And then we'll add one more value add, and this will be for the 2-bedroom units. And on the 2-bedroom units, we know we can raise the rent to $175. Say there's 80 of them. I don't have the exact breakdown in front of me here, so I'm just going to guesstimate there. And we're going to start this, let's say we start this month 18. So we actually have this tiered structure where we can start doing rent bumps, and we can add in, a few different rent bumps going along the way. We can have these start in year 4, 5, 6. But what I'm going to do is I'm going to let the appreciation rate and the income inflation rate, after we know we've done this value add here, after we've raised that rent, I'm going to just let income inflation take over from that point instead of going in and adding in, rent bump after rent bump after rent bump. We know that we're going to increase $350,000 of yearly income. It's going to add about $5.8 million of value by us doing those rent increases with that minimal capex that we have there. So I'm going to go in here now, and we're going to adjust some of these numbers from the previous section to see if there's a little bit better scenario for us here. I'm still want to refinance year 4 because the end of the interest only period. We can still run it at the 5 cap. Let's say the interest rate, just to be conservative, is about 5.5. It's 6.5 now. In 3 years, it's 5.5. What that's going to do is adjust that a little bit for us as far as the loan payments go. As we can see here, there's $11 million left from the proceeds after we've paid this prepayment penalty. Our capital account balance started at $15 million. It's now we're returning $11.2 million to the members. You see how it's broken down here, 80-20. We'll show you where that breakdown comes from in a minute. And we'll go through the same thing with the sales assumptions. So we're anticipating a 5 cap on the refi. We can do the same on the sale. We'll sell the property year 7, same sort of scenario. We're seeing here that you're returning the member capital. There's $13 million of net proceeds. of which 20% goes to the managers, 80% goes to the members. So if you take the 10.9, add the 4.2, you now have the 15.2 here. So $15.2 million is going back to the members at the sale. And we started this property with a total of 15 million. So we've now returned all of the capital, and there's about $10.9 million of proceeds. I keep going back and forth through the summary here. This is all the in-place stuff. I just want to show you that that continues to update as we go. And now let's look at the future projections. So now we've gone through and we can see what the projections are. Here's our P&L. You have our vacancy loss, our delinquency, our concessions, our actual rental income, the other income from the property, forced depreciation. So this is the stuff that we added earlier. You notice there's $30,000 of income new from the studios. Here's where the 1-bedrooms come involved. Here's where the 2-bedrooms come involved. Like I said, most of this is actually going to happen within the first year. I'm just showing that you can spread it out along the way. We remove our operating expenses and we can see our NOI starts at 2.1. By the time we exit, it's 2.7. We show you here within the spreadsheet, right, a nice breakdown what the NOI is, what the cash flow is, what's available for distribution. So as we come over here to the income analysis, we can actually break this down a little bit further. We see the cash flow is $600,000. We're going to take out that capital reserve, so there's about $532 available for distribution. That's in place, assuming the capital reserve. So notice we have in place, so this is as is. So as is, what it's going to look like. Here's the end of the first year. So what this takes into account for the end of the first year is that slight income inflation. We have our mortgage payment. Here's our cash flow, $672,000. Here's that asset management fee, that 2% of the gross that it comes out of. And then here's our capital reserve. So we know that we're taking $73,000 out per year for capital reserves. But as you notice, we were using a certain percentage of that capital reserve per year. So we have this remaining value here to show you how much is left within that capital reserve based on what we're using per year. We can come down to this section. We see what our initial capital account balance is comprised of. As you can see, our acquisition fee comes out year one. It's projected in the end of year one projections. We see there's $518,000 of cash flow for distribution and a 4.3 cash on cash. That continues to go up as we continue to add value to this property. And then when year 4 happens and we refinance, that drops again because we have now got a larger loan and there's a little bit less cash flow to distribute. And we have the same sort of thing here. We're showing your loan balance, the equity in the deal, the market value of the property, and you can see the market value continues to rise. The loan balance stays the same because of the interest-only period. New loan, higher loan balance, and then we can go down to our loan analysis and show you exactly that. One of the great features I really like about this tool is we project, if you didn't put a refi situation in here, we actually just project how much you can pull out in what year. So we know that our initial capital account balance was 15.5. When we refi, we want to return at least 80% of that money. This is a perfect time to refi, right? So we get to this point. We've now refinanced this loan. We have our new loan balance of $36 million, and there's no potential cash out refi because we've refied. And here's our sale analysis. So we show you our refi proceeds right here. That's coming back into play. The selling cost, what year you would want to sell. You lose money, obviously, if you sold the first couple of years. The cumulative cash flow. So this is really our total return. And then the remaining reserves. Now that was the capital reserves and the replacement reserves that we've had for the property, the percentages that we've said that we were going to use those reserves, and our capital account balance. As you notice, beginning of year 5, that capital account balance is now $4 million. When we do sell this property, we know that we're going to make 126% of our money, $19 million total on this property. That's a really good return on this property, a nice looking deal. And what we're going to do now is go through to the next section, which is the investor breakdown section. So in the investor breakdown section, this is where we can actually see what are we getting paid. Now we can change the waterfall distribution. Say you're 70-30, 60-40, 90-10, whatever you want that to be. you can actually change that right here. But what we're going to do is now we're going to add in these equity partners. So we're going to add in our managing partners first. So say this is our lead general partner. We have a co-general partner, a KP, a silent partner, strategic partner, whatever that is. We're going to take, say the lead general partner here owns 50% of this deal. They're the one who found the deal. They're working on the deal. This is their deal. They're bringing in another equity group, and now they'll own the other 50%, or we can break that down further. But one thing I want to show you here is we're breaking down the managers now, right? So we need this to be 100%. So we've only added 50% of the management team. We then need to add 100%. Once these turn green, we know we're at 100%. So we're going to add a co-general partner to this team. That person is taking 30% of the equity. Maybe that's your capital raiser. Your capital raiser generally gets about 30% of the deal. So maybe that's your co-general partner. And say you need someone to sign those loan docs for you. Well, that person is going to get 20% of the deal for signing the loan docs. Now what we've done is the entire management team is put together. We have each one of the general partners. Now these can be, you can break this down percentages how you want, but we want to show you here, they're getting this percent of the acquisition fee, they're getting this percent of the asset management fee on the annual basis. All of that breaks down, we're at 100%, we're at the 2% fee, 2% asset management fee, and now let's add limited partners. So the limited partners, we allow a little bit more flexibility. First, what you'll see up here is a preferred only arrangement. I don't know if you've ever seen deals like this, but we've seen deals with several different asset classes, and one of those asset classes specifically is a preferred only arrangement. Now, I don't personally do that. I'm not going to throw that in this analysis because I'm doing this based on what I would do. But if you wanted to, you can say, hey, they're preferred only, Group A. They're going to invest maybe $5 million into the deal from that preferred equity standpoint, and then they get like a 9% preferred return or whatever that pref is built out. What we'll actually show you here is that of the $432,000, the first 9%, $450,000, goes to this group, Group A, that pref group. Personally, I don't love that strategy. I think it kind of, it really only incentivizes this first group to get paid since they have a pref. I'm going to delete that group. I'm not going to ever do that in a deal unless it's some sort of mezz equity situation. But that's a little bit different than this. So we're going to say Group 1, they're 50% of the deal. If they invest up to a certain amount, they get a 6% preferred return. Still showing the preferred return, right? We still have a pref, but they might not get the same percentage as somebody else. So let's go with LP Group 2. Those limited partners, maybe in Group B, they own the other 50%, but these people all invested like $1 million or more, and they were promised, I don't know, like a 5 pref, or they'd had no pref actually. Let's just do it with no pref so you can see what that looks like distribution wise. The other 50% in Group B of that equity has no preferred return. These people may have invested a little bit more money, so they get a preferred return. You can break it down however you want. Just for this example purposes, I wanted to show you what that pref looks like. Again, now we're in the cash flow analysis of this property. So pretty similar to what you saw in the other section in the projections, but now we're in the investor projections. So same sort of thing. You can see the refi proceeds, how everything is broken down. Very easy for you here. You notice this line, there's no preferred return deficiency. Because the property has enough cash flow to cover that preferred return, there is no deficiency on that preferred return. We have the net proceeds, the return of member capital, how it all breaks down. You can check this out in each one of the sections. Yeah, I'm going to go through, sorry. For those of you who can't see the audience here, this person is persistently asking the same question about what the member returns look like. Let me get there. All right, so we are in the member returns and cash flow section. So this is where we're going to project our member returns. So this is the total for the members, right? This is their total return on investment. The members invested 14. They got their 15 million. They invested 15 million. They got 14.5 million plus their $15 million back. And that gets broken down now by group. You see this group that a preferred return, this group didn't get a preferred return. There's no deficiencies here. Well, I guess there is. There's a deficiency this year. Preferred deficiency, they weren't paid out. Well, that gets paid out on year 5, and then the rest gets paid out in year 6. So we can see when those preferred returns were actually paid out to those investors. They didn't get it those years. Unfortunately, Group B, with that pref in place, is not getting paid year 4 and year 5, but they are getting paid on the sale of that asset. They're still making a really good return. They just didn't get a pref, and that could be because they didn't invest a certain level of money. So some groups do it that way. We personally, especially in these times, are not doing preferred returns on deals. I think it's a little bit of a risk. I know people like to see it, but I would rather not get lied to. When I hear preferred return as an investor, I think it's almost like a guarantee, right? A guaranteed to get that money. Well, if it's an accruing preferred return, if they only make 1 or 2% in the first year, they're not going to pay you that 6%. So we do account for that in the preferred deficiency section. But me personally as an investor, that's not like our style. We don't do it that way. Here's the manager breakdowns, and same sort of thing. You open the eye, right? And you can see what the general partner is going to get. And we actually break it down even more granular for the general partners to see exactly what each person is going to get. So the KP, the first year, gets 162, 30, 36, 18, this is the refi year. Obviously, there's less cash for distribution. But you can see at the end of the day, at the end of this asset, the key principal is going to make $800,000 for signing the loan. The co-general partner, maybe the capital raiser, they're going to make $1 million, $1.2 million. And the lead sponsor in the deal is going to make $2 million total. So pretty good return for the managers, pretty good return for the members. Class A asset, again, you're not going to get those same sort of juicy returns that you might get on a value add deal, but you also have way, way, way less risk. So with less risk comes a little bit less reward, but your money is much safer in one of those type of deals, especially if there's fixed long-term debt on that property. Now that we filled out this section, we're going to go into the records. This is the same as on the quick, right? You can add a note if you want to add a note, whatever that is. Jesse analyzed the deal, blah, blah, blah. It'll stay there. Everyone can add to the different notes. And document section, again, if we wanted to upload the T12, whatever we have all of that information available, and we can load that right here within the documents section. What I'm going to do now is I'm going to generate a report on this property. And what it's going to do is, here's a nice property report that we can then share with somebody. We can send them this link. We can send them what scenario we want. We can email them that deal. You can share this with your lender, whoever you need to share this information with. We can see it's a $36 million purchase price per door. Average unit income, that's including now the other income into that property. 246 units. We show the occupancy rate here. Here are the metrics, right? This is the first year, so these are the first year metrics. You have your projections here, including the forced appreciation that's within those projections. We know it's adding value to the deal, so those projections are available right here. We know that our new value add is now $5.8 million. Buying it at a 5.9 cap. Our loan on the property, 65% LTV, our 9.5x capex, all of the things that are included in this, our mortgage interest, monthly payment, and our capital structure. So all of that is available right here. What is also available in this market report is the market research, right, in this property report. So the same market research you saw in the quick underwriting, presented, a little bit different style because it's mainly within this report. You can still view the details on these other assets, see what amenities they're offering, what kind of fees they're charging, what the units look like. All of this is available right here directly within the tool. You get to really see and compare all these different properties, which is fantastic for you to know what amenities are provided, what the property really looks like. That's a beautiful pool, by the way. What the properties look like, in this area, what your direct comps are, and there's a phone number there that you can just call them. If you want to, you can call these. And find out a little bit about them. And again, this looks like a brand new asset built in 2015, so around the same time. They didn't list any of their services or additional charges. They just showed you their application and admin fee. But we can go through this whole list of properties here and pick out the ones that we want to use as comps for us. Again, same sort of report that you saw earlier. The Whole Foods is right here. We show you it right on the map. You can switch views, and go back and forth. It looks like, hey, we're definitely building something right here. This is probably another apartment unit or development. But all of that information is always available right for you, right here within the app, organized by, distance closest first to help you out with your analysis and the area analysis. And again, that demographic data right here, right at the bottom, easy for you to access, all right here within your report, within the report on DealWorthIt that you can then share with your team. If you wanted to run, so somebody just mentioned, what if you want to run a scenario with different interest rates? So we can do that. So what we'll do to answer your question is we're going to just take this scenario, offer one, and we're going to clone it. We're going to call this, new loan details. Maybe we bought it down. Really just depends on what that is. Maybe it's an assumable loan. So maybe we're going to run this under a loan assumption. So what we'll go to is we'll go into the acquisition, and we can play with this loan now. You can say, hey, maybe you're getting an assumable loan, just so you know it's assumable, and there's a couple years of prepayment left. Let's say there's maybe year 3, year 4 left on this property, and your interest rate on this loan is maybe 4.75. I don't know, I'm just throwing things out there. There might be 12 months of interest only left, and the loan amount could be around that $23 million. I'm just going to keep that the same just for ease of this. But what it's going to show you is we're going to have a massive amount of return on this deal because of that assumable loan. And we know that we may have to. We now in our new loan scenario, we may have to refinance this loan. As you can see in this, we're repaying the outstanding loan. There's a little bit of proceeds, return to member capital. There's nothing additional to distribute here. Our interest rate is now higher than it was earlier. We do have that interest only period. We can run this at different cap rates. If we think cap rates are going to compress, we can say it's a 475, 475 cap. That's obviously going to spit out a little bit better returns for this property. We can say, hey, we want to refinance year 3 because there's only 3 years left on that loan. We maybe want to refinance year 5, year 7, whatever that is. We want to dodge that prepayment penalty, so let's, we refinance year 7, right? There's a lot of different, oh, that's right, look, error. So when something's messed up and it doesn't want you to do it, it'll tell you. The tool is going to tell you, hey, we'll refinance, year 6 on this property. Ooh, look, there's a little proceeds to distribute to our investors. They've gotten all their money back. They've hit infinite returns with this new assumable loan. And we're going to probably now, instead of selling it year 7, we're going to sell this property year 10. And we're going to try to make a good amount of money, which we can here. And we'll jump right into those future projections. So this is what you do. Obviously, if you're getting a new loan and you want to take multiple scenarios, you can still run them. You can see here, there's plenty of cash flow to distribute based on those new loan. Once you've gotten all your money back and you're at that infinite returns point, not a lot of cash flow for distribution because you're at the infinite returns point. So what you're getting here is now a large equity play at the end. There's not any cash to refi there. Sale proceeds, again, really, really great. You're at infinite returns, and then you make a bunch of money on the back end. And it was all because you assumed that loan. Those are things, again, you can see that in the report, right? If you send this over to your lender, you're going to see, wow, 6.5% cash on cash is great, especially on a Class A asset. We're trying to be in the 4 to 6% range on these. We can compare these scenarios now. Here's all the scenarios. There's their purchase price originally. Our occupancy, we've changed that to be a little bit more conservative. Our reserves, we've changed from the initial. Our capital reserve, now we've added, that obviously wasn't on the first one because that was cloned over and we didn't work with that scenario. What you could always do is when you do convert this to, the full underwriting model, you can always delete these scenarios. You can delete the scenarios and start new ones. There's no need for you to keep them, if it's something that you're going to be changing anyway. So we can just delete this scenario, not a big deal. I want to delete it. And when you're done fully underwriting the deal and you have your numbers, you can go right here into your dashboard, and the deal's right here. So we see here is the quick version. There was the option to delete it when we did that conversion. I keep them both. It's nice to see what you did quick and then what you finally get through at the end. So here's the deal. We can jump right back into it if we want. Say the broker comes back to us and say, hey, 36 doesn't work. You guys need to be closer to 37.5. So let's go at 37.5 and then run the deal that way. So it allows us to go through that. Obviously, we've changed the purchase. We need to go into the loan. We're going to drop this loan. I'm going to throw a new one in it. Same sort of thing. We can now analyze the deal at the new price. We're going to do that 648 that we did earlier. Hey, maybe we get a better quote from the agency, and they're going to give us 60 months interest only. There's a lot of that 5-year interest only is not an uncommon thing. I could put a prepayment penalty in if it's a 5-year step down. I'm not gonna bother putting one in right now, just for this example. Say we're doing it that way. Here's our new loan. We're going to go into our future. We know we need to refinance on this property. We need to now refinance year 6 because the prepayment penalty. We want to dodge that, and we still want to hold it for 10 years. Now, what do the projections look like with this new strategy? We can go right here into those future projections, and what does that look like for us? Really good NOI to start, good NOI at the end. What are our sales presumptions going to be? We can go through and analyze these deals quickly with only changing a couple scenarios. And honestly, I should have cloned that and said offer 2. But I was just running through this quick for all of you here. So same sort of thing. Everything's on the side. We still have our in place. This is what we're going to do as is. This is our negotiation point. Everything else beyond that is speculation. But you want to be able to break those things down, see what your investors are going to get, see how much cash flow is available. As you can see, this pref group, they're going to have a deficiency. Group B is not going to get paid any sort of cash flow. The general partners on the deal aren't getting paid cash flow. They are getting paid their fees. This is their year 1 fee. This is their asset management fee. So they're getting paid the asset fee, but they're not going to be making any additional cash flow, and neither is Group B because of that pref group. So you can go here, analyze deals multiple different ways. It's a very, very simple process. We really wanted to make it as simple as possible for everybody to go through and be able to analyze deals further. So if you have any more questions, we've got a couple minutes left on the webinar here. So if you do have any questions, please do put those in the chat. I know Daniel's been doing a great job of answering some questions, and most of the questions that y'all have asked, I had actually answered throughout this process. So if you do have anything else, do let us know. Yeah, perfect. Mark, the pricing structure here, you can go right here into my subscription. Here's the plans. So the silver package is $59 a month. It allows you to do 50 deals per month. It's the quick analytics. So if you just get a few deals, you're kind of learning this, or you just need a quick way to sort through some deals that you think are good, but you don't really know yet. You don't want to spend 30 or 40 minutes analyzing it by hand. You don't want to use one of those spreadsheets because honestly, the spreadsheets can get a little, they're a little convoluted, especially if you change a cell and the cells are all linked. Like if you have a sheet that you've made and it works for you, this probably isn't the tool for you. Unless you have, another way to analyze deals, right? We're not trying to push this. If you have something that works for you, go ahead and use it, right? But if you want a tool, a software that's easy, it stores all your information. You don't have to keep copying and pasting spreadsheets and duplicating and doing all of that. You just want an easy version where this keeps all of your deals organized for you. That's what this tool is for. We wanted you to be able to hit the easy button while you're underwriting deals. The silver package, it's great to quickly go through deals. Now, if you're a little bit more advanced, you want to underwrite deals further, or you really just want to have a full underwriting spectrum to be able to show your team or your broker, your potential investors, you're going to want to have the gold package because it allows you to break those things down, especially the investor breakdown and projections. Plus, it'll let you do it 100 deals a month rather than the 50 in the silver edition. And then diamond edition, this is what I'm using. Unlimited deals per month, everything in the silver and gold, but you get to collaborate with your team. So if you're a big capital group, even if you're a small company, Like our new fund, we have 4 members in it. So obviously we want to have up to 6 members, you being the lead person, and then your team the other. So for my case, I'd have 4 people on this. We'd have room to add another 2. So if we bring on a new acquisition guy, if we bring on a new underwriter, whatever that is, we can add those people to here. Right? You need a tool to analyze deals. You might as well save 15%. Get your 2 months free. I bought this up front originally when I was when I wasn't a partner in the company, when I didn't buy into the company, I wasn't an equity holder in this company. I bought the year version because I needed a tool that was much easier than the spreadsheet that I had spent a few $100s on to use, that continuously had some bugs, and it just wasn't ideal for my scenario. So I went and just bought the yearly package. Wanted to show you one more thing. We actually have a partner program. So anyone who's interested in helping us scale DealWorthIt, we actually have this partner program. So you can earn a 20% recurring commission on everyone you sign up. So if you have the gold package, for example, and you're spending $99 a month, you share that gold pack. If you share with 5 people, you share DealWorthIt with 5 people, they sign up, they use the tool, you'll actually cover your expense on that on a monthly basis. So DealWorthIt would then in turn be free for you. Anyone who's not familiar with the affiliate marketing model, it is absolutely a fantastic way to add another revenue stream to your business. So for example, one of my old companies that we exited several years ago, we had a recurring commission from the tools that we did consulting on. So we did consulting for a couple different real estate analytical tools that were more like big data rather than like I guess it's not as analytical. It's certainly not as analytical as DealWorthIt, but we did a lot of referrals for those businesses as we consulted them on how the software and how the tool should work, as well as bringing in massive amounts of leads. We had checks coming in on a consistent basis, $20,000 to $30,000 a month per platform. We did wind up exiting that business, but we're back in this space. And to be honest with you, I'm not getting paid as an affiliate anymore. Obviously, I own part of this company. But I'm here to help and show exactly how to do affiliate marketing. So it's a really, really great and easy way for you to earn, like I said, 20% commission. We have a back-end platform for you within the affiliate program. That is logos, it's screenshots, it's videos, it's the kind of how-tos, how to use the tools. All of that information is available for you to go ahead and do your own marketing. Now you can do what we did. We did a paid ad model. That was specifically because we knew how to use Facebook targeted ads before most people did. So we were able to generate a lot of good leads from that on the other company. Now I'm not saying you have to do that. Nobody does. But if you are interested in earning a recurring commission on a monthly basis, as people stay on with you, you do get paid on that, 20% of it. So say for example, you got 20 or 30 people coming in. They're each paying $100 a month. You're getting 20% of that on a monthly basis. So I did want to mention this, the partner program. It is, like I said, a 20% recurring commission. Now, if you're a coach, if you're a real estate coach, or you have a platform, you have a group, you have a network, give us a call. We can work something out, maybe a little bit different with you, depending on the size of your community. Our major goal is to get DealWorthIt into as many hands as possible and help as many people alleviate the burden of underwriting deals. So if you are interested in becoming an affiliate of DealWorthIt, go over to dealworthit.com/partner or dealworthit.com and click right here in the top right corner on the partner program. That'll bring you right to this page and you can start earning now. So those of you interested in becoming an affiliate of DealWorthIt, we do have that program set up, ready to go, and you can get started today. If you have any additional questions, concerns, anything about the tool, about the partner program, how you can get involved, email me, jesse@dealworthit.com. And same with Daniel. Daniel says daniel@dealworthit.com. Very simple, easy to remember. Again, those of you interested in the partner program, let us know. We're happy to help you get started. And those of you interested in DealWorthIt, if you need a couple more questions answered, if someone didn't answer your exact question on the webinar, and you're watching this video after the fact, feel free to reach out to us anytime. You can use the chat feature. You can also just, again, email us, call us, text us. We're always here, happy to help. Thank you for your time. We really appreciate you joining us today. I know we went a little bit over what we were supposed to, but I wanted to cover some extra things and make sure we got all of those questions answered. Thank you all for the people who stayed on the whole time. We really appreciate you. We look forward to working with you all. Again, if you have any questions, reach out to us. We're happy to help. Thanks again for your time, and I hope you all have a fantastic day.